Koul is now joining us. He's APAC equity strategist at Goldman Sachs. Sunil, good to have you with us here. Thank you very much for your time. It's a strong start once again. What's the view, both tactically and a slightly medium-term view on the markets from here? Because we've done exceptionally well, and the question is a pullback, or we'll continue to march higher in a very steady fashion. What's your sense?
Yeah, Prashant, pleasure to be back. Look, I think in terms of the strong start, I sort of mentioned this in your show last time. If you, for example, looked at the market returns last year, the market was up 20% or so, but a lot of that move was basically driven by underlying earnings accrual, right? And so in aggregate terms, the market was actually flat in terms of valuation. So at 22 times we started the year, that's where we ended on 2023. So in terms of that was a good move in terms of driven by underlying fundamentals. I guess at this point, I would say we still are constructive on the markets overall. We have India as our core overweight allocation within the broader region. I think our sense is that valuations are indeed expensive, but even with baking in some derating in our numbers, we think on a full year basis, market should be higher, largely on the back of underlying earnings. We still think earnings grow around 15% compound this year and next, and that should drive the markets higher. So in terms of the path to your question, I think near term, look, I think markets may kind of moderate here because growth has been moderating at ad. We also are seeing the current reporting season, which is somewhat mixed. I mean, in terms of the beats versus misses, we are almost 80% through in terms of the market cap for the headline indices. And there, I think it's like 40% beats, 40% misses, 20% in line. But more concerning is the fact that a lot of the numbers are kind of much more driven by margin expansion as opposed to volume growth. And so only 15% of the stocks have actually beaten on revenues, as opposed to 40 plus beating on margins, right? So it does seem like earnings on the margin are a bit mixed, and so our base case is markets sort of consolidate here until probably sort of second quarter into the elections, and then post elections you start to see markets moving higher. But I think on a full year basis, still very optimistic. Think markets should be higher, 8 to 10% returns overall for the markets.
Okay, 8 to 10% returns overall for the markets. Got that. Sunil, hi, good morning. And as always, thank you for being with us on the channel. I was going through your report, your strategy report. One of the big themes that you like for 2024 is this energy transition theme. You talk about how India is growing and decarbonizing simultaneously, and there is big potential here for investors. Can you just take us through the fine print of that? If I'm an investor today and I want to capitalize on this theme, which are the sectors, stocks that I need to be looking at?
Yeah, I mean, we have been over at that camp, Sonia. I think, as you said, the core thesis is that of a peak sort of power deficit in the country. So our sense is that given the demand supply in that sector, we will continue to see shortages. Obviously, with the winter months, the demand kind of came off a little bit. But I think as we start to get into March, we probably think we again should be seeing power shortages. And that means that the legacy thermal business in some of the stocks should also continue to enjoy a re-rating. So I think on the renewable side, some of the stocks have already run up. So we have neutralized view on those names. But from the core utilities and power sector, especially on the legacy thermal business, we continue to be positive on those names. So I think utilities is one of the core overweight sectors we have in India.
All right. Hi, Sunil. Good morning. Nigel on this side. I think your target on the Nifty is around 23,500 for this year?
That's right. I mean, obviously, I think you have to look at the target in the context of the broader region. Okay. So for the region overall, we have around sort of 11-12% upside for the broader region. A lot of that being driven by China as well. So barring that, we're kind of looking at high single-digit returns for most of the markets. So India also is therefore in that camp. And I think the core view being that it's the underlying earnings, as I said, that will be driving markets. Yes. So with a bit of sort of low to mid-teen return earnings expectations and a bit of multiple derating, we think that's where the market ends up.
I recall that point, Sunil. You said, yes, the Indian markets have done well, but earnings have kept in step. So that's why the markets are still on a PE basis. We've not seen a big expansion out there. All right. The next big event is going to be the RBI policy for us. And in the backdrop of, say, the Fed may not be cutting as soon as, earlier thought, what are you penciling in? Do you expect the Fed to start cutting in March, or do you think that it's going to be in the middle of this year? And in that sort of a backdrop, what are you working with in terms of, RBI action?
RBI. Yeah, look, I think on the Fed call after the FOMC last week, we also pushed back our Fed first rate cut expectations from March to May. So we are now kind of looking at 5 rate cuts for 2024 overall. So 4 25 basis points sequentially and till September, and then the final cut in the month of December. So for Fed. For RBI, which by the way should be sort of positive for markets in general. I think if you go back to Fed rate cutting cycles, in general, most Asian markets on a 1 to 3 month basis after the Fed starts cutting tend to generate positive returns. So I think that should be positive overall for the markets. For RBI in particular, we obviously in the policy tomorrow, we do think they will stay on hold. And I guess the reason behind that is if you, for example, looked at the growth versus sort of inflation trade-off, our general sense is that, growth is a little bit sort of mixed. You got investment growing stronger, but consumption is still a tad weaker. Inflation is still at high above 5%. And so we think they'll probably continue to stay on hold. But I think what's more important in terms of the policy would be the focus on liquidity. And on there, I think the sense we have is that the pain you had, or the extreme pain you had a few weeks back in terms of tightness and liquidity, is probably already eased given the intervention from RBI. That should be on the margin good for banks. But what they will likely do is liquidity probably stays still in deficit in the current quarter. I think Q2 calendar, the liquidity starts to ease. By that time, I think they get better clarity around Fed. And if you're right, Fed would have started cutting already. And then they start to sort of ease liquidity in Q2. And then the actual rate cuts start in Q3. So we're kind of penciling in 50 basis points rate cut for RBI starting Q3, which takes the repo rate from 6.5% to 6% on our estimates.
Right. Sunil, since you're a global house, you'll have a view on China as well. I mean, I just want to actionable for those, the market's been completely bombed out, right? Valuations are cheap, etc. Does it make sense for those with some investable surplus to put money into, and there are some of those mutual funds here which have these, China funds, etc. Put some money and just forget about it? You think it makes sense?
Yeah, look, Nigel, Prashant, you're right. The market obviously is down significantly. It's down 60% from its 2021 peak. Valuations, as you pointed out, are around 8-9 times, so still very cheap. We look at a lot of the allocation data from both hedge funds and mutual funds, which are at 10-year lows. So clearly, I think the risk reward looks favorable here. I would say I think the incrementally what the government has been doing. They started with some modest easing measures in terms of rate cuts and RRR cuts, which the investors were not very pleased with. And I think the latest news flow around they setting up a market stabilization fund, RMB 2 trillion. That's what has got market a little bit of comfort, and we're already seeing some buying happening. And the move last night in terms of MSCI China of 4% is kind of reflecting of that short squeeze. So our sense is that it sort of makes sense because the risk reward looks kind of skewed to the upside. Having said that, I would say, we still need more forceful policy measures from the government for investors to get comfort on. And if people have to choose within the China markets, we are much more positive on the onshore markets as opposed to offshore markets. And in onshore markets, there are a few themes more geared towards the self-sustainability, industrial automation, more kind of the hard tech, which is where we think government is focused on, that we think could do well.
Okay, by the way, the mid-cap index is now soaring, almost 400 points higher on the index, and plenty of stocks actually buzzing. Inox India, we've been talking about that ad nauseum, 1,050 now on that stock. Remember, the issue price, the IPO price of Inox India was 660 rupees a share. So it's been a big mover. Of course, it listed itself at 950, and since then it came off a little bit, but now at a fresh high there, 1050 on Inox. India doing pretty well. Paytm is up almost about 10%, so don't lose sight of that. And something like EIH is up almost 16%, so big moves there. But Sunil, in your report, one theme that you really like is the defense theme. You talk about how indigenization is something that, could lead this sector to move higher. But the problem here is that there seems to be too much of a run-up in stocks, maybe a little bit of over-ownership as well. I mean, something like a BEML is up 170% in a year. So do you think that this story has played out in its entirety?
Yeah, Sonia, I mean, that's a good question. Let me step back a little bit on the broader sectors. Look, I think if you look at the medium-term themes, some of these, whether you call some of the Make in India PLI stocks, some of the industrial names there, some of the defense names, you're right. I mean, these are longer-term themes we still like and we have extensively written about. In the near term, some of these themes have done fairly well. And so maybe sort of market takes a pause here. But I would say in terms of the broader themes within the industrial bucket, I would say where we still think there is more juice left is probably more around the building materials theme, because we still think that the real estate continues to recover there. Obviously, the real estate stocks themselves have priced some of that already in. But if you look at the broader building material themes, for example, in terms of sort of adhesives and pipes and laminates and plywoods and all of that, that's a theme, for example, which hasn't been sort of fully priced, and we think there could be some more upside there. But I think to your original question in terms of defense and some of the other sort of industrial names, we do think with a bit of capex, new fresh infra kind of slowing down here and run up in those names, they could probably take a bit of breather in the near term.
Okay, Sunil, we'll leave it at that. Thank you for discussing all of your themes with us and your target on the index as well. It was a infotainment, as we call it, right? Information, but entertaining as well. Thanks for being with us on the channel. Well, that is the word coming in from Goldman Sachs. But let's get